In the meantime, let's talk about the Finance and Development magazine of the International Monetary Fund for the month of March, which was focused on the rapidly changing global economic backdrop. There leaves less room for monetary policy authorities to maneuver from geopolitics to the war in Ukraine, inflation, digital money, among other challenges. These are real tough times for central bankers around the world. Now, chatting more to me on this now is Professor Ken Ife, who is a development economist and is joining us live from Abuja Studio. Professor Ken Ife, thank you very much for coming through tonight. Quite a bit of issues we're dealing with our big neighbors down there in South Africa, but we'll get to that a little bit later. Let's start with the monetary policy. The central bank central bankers are having tough times right now. Of course, Jerome Powell, the U.S. Fed chairman, will be speaking tomorrow, giving the testimony before the Congress on the Capitol. But what are the global issues right now, based on what the IMF just published 4 days ago, as far as central banks around the world is concerned?
Well, first of all, we know that the recession, the recession came with the COVID. So COVID-19 and the associated recession made a lot of countries borrow, and the debt sustainability for many countries are actually questionable. Then, of course, you now saw the global challenges faced by the Ukraine-Russian crisis. Not only that it is hitting energy bill, but also grains and many others are affected. And that also has a lot of ripples. And so the interactive effect of these two actually resulted in something nobody was expecting. Now, let me tell you something. All the central banks all over the world have experience on how to deal with recession. And many of them know how to deal with it. Also, all the banks know how to deal with inflation. And that's what they've been doing all their life. But what they don't know much is how to deal with stagflation. That is a combination of inflation and recession all happening at the same time. They normally ought to be pulling in different directions. There isn't much experience on how to deal with this against the backdrop of the fact that many of these economies, especially emerging economies, have different set of objectives compared to the more advanced economies. America would have employment and price stability as their major objective. Nigeria would say, okay, price stability, financial system stability, and also supporting the economic growth and diversification, which it means we have to find ways and means of making sure that we can promote growth. So they look at some kind of cocktail of measures. And that is what happens with many of the other central banks in the emerging markets. They have debt to deal with, debt overhang. They have issues around rising inflation, and they have stagflation, and they have many other objectives other than just those two that America is preoccupied with. So this is not the time when IMF can prescribe for anybody. IMF can say, well, many countries that do this are likely to be out of it. It's likely, and it can't be very prescriptive.
Interesting background to some of these issues we have on our hands. But how crucial are these global crises for monetary policy authorities in developing economies and frontier economies such as Nigeria?
Well, one thing, of course, in the fiscal realm, there's been so much international cooperation and, around fiscal measures. But what you haven't actually had is sovereign nations, the central banks of sovereign nations, collaborating and cooperating on monetary issues. So this is the time where they are now having to say, oh, there must be some set of monetary issues that we can agree on. So this is the beginning. It's very early days for them to think in that way. Whereas if you look at regional integration agenda of many regions, it's all around the fiscal infrastructure, this, that, trade, all of that, but not on monetary policy. So now they are being challenged to see whether they can find common grounds on issues relating to monetary policy. But that hasn't been the tradition at all. So it's very, very challenging times. And Nigeria, of course, is a much more complex array.
Professor, in the last 2 years, the IMF, the World Bank, were all asking central banks to support the fiscal authorities, the governments in various countries and regions, because they said the COVID-19 pandemic and the whole global trade impacts and whatever, logistics and all of that, and then the Russian war in Ukraine. But so the central bank started printing money all over the world, and they keep supporting social interventions and all of that, and they keep putting all of this on the back of the government, and there's so much easy money all over the world in the manner of speaking. But here we are right now, the same IMF and other multilateral agencies are asking the central banks around the world to slow down and not to raise rates. So where does that leave us? What sense do you make of that?
Well, obviously, you could see the effect of borrowing. You could see the effect of printing a lot of money. You could see the effect of overdraft to governments. I mean, in the case of Nigeria, it's not 5%, is many, many hundreds of percent. And we've got about 24 trillion. So different countries are in different pages on what they have done in relation to all this spending money and putting there. So the bank is saying, okay, that period is over. Can you now begin to, suck these monies out of the system? And then you are doing it at the back of pressures coming from the rising energy costs, rising grain prices. So it's very difficult for them. And that's why what we have is stagflation. It is rising inflation and also having to face recession, the prospect of recession. Juggling the two is not easy because you are juggling them against the clear objectives of those central banks.
So the primary objectives of the central bank, just very quickly, Professor Kenife, this is what the former governor of the Reserve Bank of India, Raghuram Rajan, says. She says less is more. It says central banks, and that's in this latest IMF monthly F&D. It says central banks should refocus on their primary role, price stability, while respecting financial stability.
Correct. That's true. The most primary objective is price stability. And of course, when you say price, there are many things on price. Forex is price, inflation is price, you have all this exchange rate is price, NPR is price. So all of that is the major one. But don't forget that for America, after price stability, what is the next one? Employment. And then for Nigeria, the second one is financial system stability. For America, they believe their systems are stable. In fact, 2008, it was mortgage subprime crisis that caused the meltdown, financial meltdown all over the world. But here, what mortgage do we have here? It's still a very infant industry in Nigeria. So we have our own challenge. Our challenge is what do we want to do to our economy? We want to diversify our economy. We want to add value to our process production. We want to create employment. Only 7% of young people are coming out from the university with jobs. We have so much of that. So we now have a secondary mandate for the commercial bank, for the central banks, to promote sustainable economic development. That's why you get them resorting to domestic finance intervention to be able to augment and deal with structural issues that don't exist in the advanced countries.
But that has been questioned. That has been questioned, Professor. That interventionist posture of central banks, not just in Nigeria and a few other economies, now being questioned by the IMF, by other agencies, globally speaking, that look, you need to go back and refocus on your primary responsibility and less of interventionists. So where does it all come together? And this is where what the professor of macroeconomics at the European University Institute, Giancarlo Cossetti, is this how he put it, said exceptional circumstances such as the pandemic may call for monetary and fiscal authorities to work together, but only temporarily and never at the cost of their independence. Do you think we've seen too much of the central bank in the same room with the fiscal authorities in Nigeria that is a time perhaps they need to go to one of them needs to go to the other room?
No, we've always advocated a closer working relationship between the two authorities, and they worked very well in 2020, if you remember that, when the president called the two of them, finance minister and central bank, said, go and do all you can to rein in inflation, to recession, to fight the COVID-19 and recession. And they did, quantitative response. So we saw that they worked together. And that's why within a quarter, we jumped out of that recession. Yeah, but the thing is that it's not just about fiscal and monetary policy authorities in one country working together. There's also the global dimension, because the fiscal authorities are working well globally in so many alliances and regional agreements, all of that, infrastructure, connectivity, and all of that. But the monetary authorities have not been working together globally. And so they needed to be more globalized agenda on monetary policy. Why? Apart from having to work well together at home. And then they have to work at home because of the intensity of the structural factors that are holding down the economy and making it difficult. Let's first, for example, CBN had to change the currency. And then one of the reasons why they were pointing at that was how to tame insecurity, how to tame price inflation, and how to deal with all kinds of money that are outside the system, that 80% of what should have been circulating is all out there under people's pillows and all of that, leaving little room for transmission of monetary policy. They have all those challenges. That's not the same with many countries. They all have different challenges. These are peculiar to Nigeria. So you can't come and tell Nigeria, oh, if you remove a subsidy, fuel subsidy, then all the problem will go away. No. It's much more complex than that. So every country will look at their monetary policy instruments and see the combination, the cocktail of those that can help you. And of course, with cooperation from the fiscal authority, so that you can try and rein in inflation that is, completely spiraling out of control, and at the same time still have reasonable growth that will help you, if it is inclusive, that will help you improve employment and then also poverty reduction, reduce poverty reduction. So all of that you can't have one size fits all. So IMF has to be a lot more careful and circumspect in telling countries what to do. You just say, well, evidence is that people who did some of this ended to have better control over their inflation. But you can't be very prescriptive.
So I'm sure we'll both agree that we need urgent monetary policy issues, rethinking, and actions in Nigeria. Give me a list of top 3 items, urgent monetary policy issues that you think we need to focus on as Nigeria begin to look at the change of administration in less than 90 days from now.
Well, we've always known that the suspect is always inflation. How do you rein that in? And what policy options do you have in the monetary realm to do that? We're no longer talking about increasing the non-domestic lending to we've gone very far on that. We have private sector lending is quite robust. We are now thinking about how do you get more control, more fiscal, more monetary policy control on the currency that are available to you. So we've got a policy that is heading in that direction, but there are challenges on its implementation. Everybody knows that. And there are others that could well come from countries working together around the fiscal realm, because some of the challenges disturbing the whole thing domestic is actually exogenic in nature, because they are springing from global headwinds. So we need to have more cooperation on the global side around the monetary policy area. And then, of course, we still have the issue of the negative real interest rate. And we are seeing, and I was happy, 2 things, that the Anchor Borrowers Program repayment has gone up over 50%. That's good news. And I'm sure that it will continue to rise. So that means that non-performing loans in that area will come down significantly. And then also, we've also seen that the Treasury bills are going for about 9.3%, which is fine because it's closing down. The 9% is what was expected on the long-term 30-year swap. What they call it, the ways and means. So that they are closing together. It would have been more difficult for you to persuade people to invest in the 9% stock when the other one is going for 13% or 15%. So they are coming closer, and we also hope that the negative real interest rate itself, which is looking at the MPR rates in connection to the inflation, that they will also narrow over time. So that's important, but they're work in progress.
Okay, let me ask you what your thoughts are around the central bank's tenure limit for top bank executives in management position. Tell me.
Look, what that policy is not is trying to take people's bank away from them. That is not what the policy is about. The policy is looking at the importance of the finance and industry in the economy, in the overall economy. And the second challenge is, how do you bring in the talent that we have into this industry? Let me take one first. The Presidential Order 005 says all MDAs and agencies of government should do whatever they could to promote, encourage the Nigerian diasporas and talents to come in to help our economy. That is Section 5.1A of the Presidential Order 005. That is not far from what that policy is trying to do. Secondly, look at the quantum, the importance of the industry. The finance and insurance industry, their growth rate is about 18% or more. And then even though their contribution to GDP is less, about 9%. Okay, but if you look at the ICT, which is the one that so much affected that industry, the ICT is, their contribution to the GDP is 16%, even though its growth rate is about 5 to 6%. But when you take two of them together and weigh the impact on them on the GDP, it comes to 27.9%. In other words, these two industries that are working together and collapsing and merging in a way are actually accounting for nearly 30% of our GDP. So you must make sure that as critical as they are to our economy, we must find policies that are going to support their growth so that they can drag the whole economy with it. So that's where I see the merit in this. And of course, you also know that industry, if you remember in 2021, I addressed the Bankers Committee, the CEOs in Lagos, where I warned them that from our statistics and our national development plan, we expect that industry to increase in its digital transaction by 500%. So they were doing 1.8 billion transactions a year. A year after, they were doing 3.5 billion transactions. Right now, as we speak, is over 4.3 billion transactions per day. And America was even doing 1.2 billion. So the only four, and we're number 6 in the world. India and China and South Korea, we're number 6 in the world. So I said that, but I was looking at 2025. But what I have said has just happened now, where the banks were caught with, they couldn't deal with the volume of transactions that were coming. Even though the CBN has been investing on digital infrastructure, USSD, it brought in e-Naira, it brought in a payment service provider, licensed them, it brought in telcos to doing everything to ease, but the banks were slow in catching up with those because they too have to make their own investment. And that is why we're where we were. And that not only affected the currency change, but also affected the vote. The voting thing on last Saturday, because the whole system, the whole.
All right, thank you so much. All right, thank you so much, Professor Ken. If we appreciate you as always, your insight, well appreciated here on the show. Thank you so much, and do have a great evening. Development economist out of our Abuja studios.